Welcome to Boutique Connects Update with me, Joanne Baynham. Today I'm chatting to Gavin Wood, Chief Investment Officer of Camissa Asset Management. Welcome, Gavin.
Thank you.
Lovely to have you back on. And there's always lots of things we want to talk about. But one of the things that's interested me lately is this whole concept of risk. What is risk? Is it downside protection? Is it not having inflation protection? How do you think about risk inside your business?
Yeah, I think it is a misunderstood concept and fundamental to what we're all doing in the investment world. So I think there are two perhaps ways of thinking about risk, and one is on an absolute basis and one's on a relative basis. On an absolute basis, I think really what it is the potential for different outcomes. Now, the various asset classes could have very different outlooks for the potential returns. So, for example, a fixed income instrument has virtually no potential for more than what it's contractually bound to give you. So the potential is set. What it could do is it could give you less if there's a credit event and they can't pay you back. So the risk seems like it's non-existent, but because the potential is for something that's quite fixed, but there is actually risk. Likewise, on the equity front, the potential there's quite a wide dispersion. You can think about like a normal distribution of potential returns, and each has perhaps some sort of a theoretical probability. So you could get an enormously high return, or you could get naught. Could go down from 100 to naught. So it's this potential for returns. So when one thinks about risk, what one's trying to understand is what's the greatest expected likelihood of return relative to the dispersion perhaps of types of return. So in absolute terms, risk is, on the one hand, a lot of people focus on potential for loss or negative returns, but I think risk is also the potential for more positive returns. So there's upside risk. And in many respects, our job as investment managers is to come into work each day and to take risk on clients' behalf, to use our skill and to actively take risk, positive risk for our clients, so that we can generate positive outcomes and get the odds on our side of higher returns than the market, higher returns than our competitors, higher returns than clients' expectations. So that's the one formulation would be absolute sort of potential for returns. It's not just the negative side, and it's most definitely not volatility. Volatility is a very useful concept for academics who use mathematics to put together elegant models of risk and return, and it works very nicely in mathematical models to have this volatility or variance with an expected return. It's very neat mathematics. It's just not a useful risk measure for clients. What you really want as a client is you want to know what's the potential for the various different outcomes. So that's the first formulation is an absolute basis. The next formulation, which I think is much more practical, much more useful, is the intermingling of what I've just said with what a client's expectations are or needs are. So let's say you are somebody who's needing to use your savings to maintain your quality of life. Your quality of life is linked to inflation. If you're drawing an income down or you're investing for the future, you want your assets to keep pace with and exceed inflation, because that's what your sort of liability is. What you're trying to invest for is to have that comfortable retirement, or to have that pot of assets that maintains your quality of life, which is linked to inflation. Or you could have a specific thing you're saving for, and it's a very specific set goal that you want to try and aim for. And so the concept then is the intermingling of the absolute risk concept that I talked about, and that's the potential for different outcomes, and your expectation and your needs as an investor and as a client. And I think that's much more a useful formulation and much more the real world that investors are actually experiencing. That's what they're really experiencing. So to give you a couple of examples, what if your term, your outlook is and your ability to invest is for a longer term, volatility makes no difference to your life. To go up and down along your journey towards your end point makes no difference in your life. So that's not really risk. If you are investing and you really want a low volatility, very secure investment, what you may do is you may miss inflation beating returns. So you may miss your objective. So your risk is then of missing your need or your objective, which is to outperform inflation and give you reasonably good real returns. So I think that intermingling of what the expected outcomes or the potential outcomes are of a particular investment with your needs is ultimately what the risk is that clients should be thinking about and are actually facing. Sometimes they're not, in the short term, not thinking about that because they're panicking about volatility, or they're panicking about being in things that can go down in the short term. So I think it drives a number, the misunderstanding drives a number of areas of behavior that's negative and unconstructive.
We say to clients, when there's lots of volatility around and it's starting to make you feel uncomfortable, stop looking at your portfolio and then you won't know it's happening. Because to your point, Gavin, the volatility isn't the problem. It's selling on a down market. That's your problem. If you don't need the money, the volatility shouldn't bother you. And I think too many people misunderstand that. Just very quickly, because I think it's very important at the moment, income funds have been very popular in South Africa and they appear to have very low volatility. Is there anything in certain income funds that you are concerned about that the market's not thinking about?
Yeah, I think that the whole category of fixed income and income funds in general are sometimes misunderstood in terms of the risks that they pose. So one of the factual occurrences of the last couple of years in South Africa is there's been an enormous move towards advisors investing in income funds for their clients. And it may be living annuity drawdowns or maybe whatever, but I would just contend that a lot of it is with a rear view mirror in mind. In other words, they've generated low volatility, reasonably high real returns in a quite a well-behaved inflation environment. And what's gone on is now you've got an enormous amount of capital that's flowed into the category. There's a small number of much smaller universe of what that category can invest in. And those are often corporate credit instruments. It's a small number of that. And they compete with banks who also lend to corporates. And so what's happened is that the credit spreads you're getting, the extra return you're getting for taking on the risk of lending to a corporate is going down and down and down and down. And so the additional return you got 3, 4, 5 years ago when credit spreads were much higher is no longer going to happen going forward. It's just factual. You can see it on the tin. It's just not there. Give you an example is we invested in one of our multi-asset class funds in a corporate bond that gave us 400 basis points over JIBAR. And 2 or 3 years later, we sold that same bond at 180 basis points over JIBAR. So the credit spread had contracted from 400 to 180. The company's prospects were reasonably similar, and the risks around that company were reasonably similar, and yet the market was willing to take a significantly lower extra premium for taking on that risk. And throughout the corporate credit environment, you can see that lending to banks has massively narrowed in spread. In other words, the additional amount you get for lending to a bank over other options like the government. A wide variety of corporates, the credit spreads have come down. Within that, some of the instruments that you can have access to that are now finding their way into the income funds are riskier and riskier instruments. So when I talked about earlier about this concept of the potential outcomes, there are some instruments that are dressed up as floating rate notes, which are floating rate notes, but they have characteristics that in a downside, their downside is much higher than a normal floating rate note. And give you an example is the banks have a number of instruments they issue across their capital structure, which are meant to be shock absorbers in a crisis. And the top layer of a bank's capital, or the bottom layer of a bank's capital structure is equity, which can go to zero. and that's what the shareholders provide. Then just above that is a layer called AT1 capital, which can be turned into equity in a crisis. It can be turned from lending to borrowing to equity. So if you're a holder of that instrument, you're getting a floating rate note, but it can be turned into equity just when you don't want it to be, when the bank's in crisis. And we've seen that with Credit Suisse had a disastrous experience with those particular areas of its capital structure. So that's a very high risk instrument, but yet the spreads on those instruments over JIBAR have massively shrunk over the last little while since those were issued. Now, more recently, there's another instrument in the last month or so has been another instrument that's just above the AT1s, but below bank senior credit. So this is low down in the credit stack, high up in the credit risk. These are called first loss after capital instruments. They're also floating rate notes, and they've been issued by auction recently. And the spread that they've been getting over bank senior paper is about 20 basis points. So what people are willing to accept is only 0.2% per annum extra return for lending to a bank into an instrument that at someone else's discretion, the Reserve Bank's discretion, can be turned into equity in a crisis. That's a high risk instrument, and yet people are flocking. These auctions have been massively oversubscribed. So I think the risk embedded in what's seen as a low risk area of the market, the income funds, is much higher than what's appreciated. It's also factually much higher than what it was 3 or 4 years ago when the credit spreads were much higher. So you could have a couple of eventualities. You could have the credit spreads widen and these instruments make somewhat of a credit loss if you liquidate them along the way, or you could have defaults. And in a negative economic environment, you could have defaults, and these are higher risk instruments, or a bank gets into a negative situation and those instruments are turned into equity just when you don't want to, and you can make a capital loss there. I just think that there's a lack of appreciation for the amount of risk being taken in these things because they've historically given good returns and because their volatility is so low.
Gavin, I think there's a lot for people to take in there, but I think your points on income funds and people having their eyes wide open to the risk they're taking on at the moment is very pertinent, particularly after so much capital has gone to this asset class. So thanks for sharing your insights. So as always, I've really enjoyed hearing them. And thank you very much.
Thank you.